Welcome to the deep dive. Today we're getting into something really fascinating, agroforestry, or AF, and how it fits, or maybe doesn't quite fit into global carbon markets.
Right. Agroforestry itself is pretty straightforward conceptually. It's this ancient idea, really dynamic, of mixing trees with crops or animals on the same land. Simple enough.
But now it's being framed as this major, nature-based climate solution, a way to pull huge amounts of carbon out of the air.
Exactly. And that's the core of what we're digging into today. We're looking at the sources to understand the gap between the, let's say, potential everyone talks about.
The big numbers.
The big numbers, yes, and the practical realities for the people actually doing it, especially smallholder farmers.
Okay, let's start with those big numbers then. What's the scientific potential we're talking about here?
Well, the global estimates are pretty staggering. Some studies suggest agroforestry could sequester up to 2.2 petagrams of carbon over the next 50 years.
Well, hold on, petagrams. Can you put that in perspective for us? How much is that really?
Sure. A petagram is a billion metric tons. So 2.2 petagrams is, well, 2.2 billion metric tons of carbon. It's a significant chunk, definitely on a global scale.
Okay, massive potential. And where is this carbon going? Is it just in the trees themselves?
Mostly, yes.
Yeah.
Stored in the trees, the woody bits you see above ground, but also below ground, in the roots. And crucially, it builds up in the soil itself as organic carbon. Those are the three main pools.
Got it. So that's the ecological promise, huge potential. But you mentioned a gap.
Mm-hmm. This is where it gets really interesting. There's this significant disconnect between that huge theoretical potential and the actual practical financial side of selling carbon credits from these systems.
Okay, let's maybe take a step back. Carbon markets 101. What exactly is a carbon credit?
Simply put, it's a certificate. It represents 1 metric ton of CO2 equivalent. That's the CO2e bit that's either been removed from the atmosphere or avoided being emitted in the first place.
And the idea is to funnel money to projects doing that work.
Precisely. Now, there are two main types of markets. You've got compliance markets, where participation is mandatory, like government emissions trading schemes.
Right.
But for agroforestry, the big player is the voluntary carbon market, the VCM. This is where companies, cities, individuals even, buy credits voluntarily to meet their own climate goals, like net zero targets.
And that voluntary market is growing fast.
Oh, yeah. It hit about $1.4 billion in value in 2023. And agriculture and forestry credits, they make up almost a quarter of the volume traded, around 24%.
Okay, so there's real money flowing. But if you're selling credits into that market, they have to be trustworthy, right? High quality.
Absolutely critical. And that's where integrity standards come in. For nature-based solutions like agroforestry, two criteria are particularly tough: additionality and permanence.
Additionality, that sounds tricky.
It is. It means the carbon reduction has to be additional. It would only happen because of the project and the carbon finance. It wouldn't have just happened anyway.
But how do you prove that? Especially with farming. Maybe the farmer wanted to plant trees anyway for shade or soil health.
That's the million-dollar question, maybe literally.
Yeah.
You need to demonstrate that without the carbon payments, the project just wouldn't pencil out financially. It's a huge hurdle.
Okay. And the other one, permanence.
Permanence means the carbon has to stay locked up for a long time. The general standard is at least 100 years.
100 years. For trees and soil. That seems ambitious, given things like fires, pests, droughts, even just people changing their minds about land use.
Exactly. The risk of reversal is inherent. Nature isn't static. So the market has a mechanism to deal with this fragility. It's mandatory.
What's that?
Projects have to contribute a certain percentage of their credits into a central buffer pool. Think of it like collective insurance.
Ah, I see. So if one project fails, say a fire burns down the trees, the credits lost are covered by credits from that buffer pool, so the buyers are still whole.
Precisely. It maintains the integrity of the credits issued. But the very need for this buffer tells you something.
That the market sees these nature-based credits as inherently riskier.
Fundamentally, yes. Compared to, say, industrial emissions reductions. And that perception of risk ties directly into the financial side.
Which brings us to that gap you mentioned, the financial friction, where the big potential meets the market reality. You found something pretty surprising in the reviews.
It was genuinely staggering, actually. A systematic review looked at studies published between 2005 and 2024 on the financials of AF carbon projects.
Okay, nearly 2 decades of research.
And here's the kicker. None. Not one single study reviewed reported actual, verified revenues from carbon credit sales. Zero.
Wait, really? None. So all the financial figures we see, they're just estimates.
They're all based on economic models. simulating potential returns based on assumptions about carbon prices, growth rates, verification costs. It's all theoretical potential, not observed market transactions.
Wow. That says a lot about how mature or maybe immature this market actually is, especially for AF.
It does. And those models, they show huge variability. Some systems, like intercropping trees with cash crops, showed simulated annual revenues, potentially reaching, high hundreds of thousands, even millions of euros in some scenarios.
Okay, big numbers again.
But then other systems like silvopasture trees mixed with grazing land showed much lower simulated returns, maybe just a couple of hundred Australian dollars per hectare. Wildly different outcomes.
That variability alone must make investors nervous. But what about actual real-world financial studies, even if they didn't track credit sales?
When you look at empirical financial appraisals, the picture gets, well, pretty sobering. There was a UK-based study, for instance. It found carbon revenues covered only 1 to 5% of the project's lifetime costs, just a tiny fraction.
1 to 5%. So the carbon money is basically negligible.
In that context, yes. The project's viability depended almost entirely on selling the farm products, timber, crops, whatever, and getting government grants. The carbon income was maybe helpful for some initial setup costs, but it wasn't the main driver.
Okay, so it's supportive at best. And this leads to a really interesting point about the farmer's choice, right? The trade-off.
Yes, this is crucial. Often, to maximize the carbon you sequester, you might need to plant trees more densely, or maybe use different species, or dedicate land that could otherwise be used for, say, higher yield crops.
So you're potentially reducing your main agricultural income to maximize carbon income.
Exactly. Which means the farmer doesn't see the carbon payment as a bonus. They see it as compensation for lost income. It has to be high enough to make up for that loss.
That completely changes the dynamic. It's not free money. It's a business decision with opportunity costs.
Absolutely. However, it's not always like that. We did find a counterexample in the sources, a forest restoration project in northern Thailand.
What happened there?
In that specific case, the potential profits just from carbon accumulation over 14 years were estimated at $22,000 to $25,000 per hectare.
Wow, okay. And how does that compare to what they were doing before?
Dramatically higher. Traditional maize farming in that area brought in maybe $1,300 per hectare over the same period. So in that context-specific land type, significant change in use carbon could be the dominant financial driver.
So it can work financially, but the context really matters. And often, for many smallholders, it seems like it doesn't stack up easily.
That's right, especially for smallholder farmers. In the global South Africa, Asia, Latin America, they face a kind of triple whammy of barriers.
Okay, let's unpack those barriers. What's stopping the average small farmer from getting involved? Technical hurdles first.
The big one is monitoring, reporting, and verification MRV. Proving the carbon is real, measurable, and permanent. It often requires, expensive equipment, maybe satellite data analysis, definitely boots on the ground measurements.
Which costs money and needs expertise they might not have.
Precisely. The costs can be prohibitive for someone farming just a few hectares. Then you hit institutional problems.
Like land ownership.
Yeah. Actively, lack of formal land tenure. If you don't have clear legal title to the land, who actually owns the carbon stored there? Is it the farmer, the community, the government? It gets murky fast, and markets hate uncertainty.
Right. And the financial side.
It's tough. You need money up front to plant trees, manage them. But the carbon revenue, if it comes at all, only arise after verification and sale. That could be years down the line.
So a major cash flow problem. Invest now, maybe get paid much later.
Huge liquidity gap. And sometimes the price needed just to break even is really high. One Australian study suggested you'd need carbon prices over $100 per ton just to make it viable financially. Market prices aren't always that high.
Okay, so it sounds almost impossible for individual smallholders. How do they overcome this?
Two key things come up consistently in the sources: aggregation and R&D support.
Aggregation meaning grouping farmers together.
Yes, bundling hundreds, maybe thousands of small plots into a single project. That way you can spread the high MRV costs over a much larger area, making it economically feasible. Farmer cooperatives are often key here.
Makes sense. And R&D.
Research and extension services. Farmers need technical help designing the right agroforestry systems for their context, understanding the carbon accounting, navigating the verification process. It's complex stuff.
Are there examples of programs trying to do this?
Yeah, definitely. Initiatives like the Kenya Agriculture Carbon Project, KACP, the Dream Fund program, and the Amazonia Connect initiative are all focused on trying to lower these barriers, develop simpler MRV, and support aggregation for smallholders.
So efforts are underway to bridge that gap. Okay, assuming we can make the finance work, there's another strategic question. What kind of agroforestry action should be prioritized? Is it always about planting new trees?
Not necessarily. There are really two main strategies, especially when you look at supply chains like coffee. You have carbon stock creation, planting new trees,
Right, sequestering new carbon.
and carbon stock protection, conserving the trees that are already there in existing agroforestry systems, preventing them from being cut down, say, for more intensive farming, avoiding emissions.
Okay, creation versus protection. Let's use coffee as an example. How does that play out?
Well, a big meta-analysis estimated the current carbon stock in coffee agroforestry systems worldwide. It's about 481 teragrams of carbon. That's almost 500 million tons already stored in those shaded coffee farms.
That's a lot of carbon already standing. So what's the potential for creation, planting more trees in coffee systems?
The potential is significant. Converting, say, unshaded monoculture coffee to shaded systems could sequester up to maybe 86 teragrams more carbon. That's a good amount.
Okay, nearly 90 million tons extra. Sounds worthwhile.
It is. But here's the critical finding. The potential loss, if existing shaded coffee farms are intensified, meaning trees are removed, is much, much bigger. Potentially up to 221 teragrams of carbon could be released.
Wow. Wait, so the loss from destroying existing systems is potentially more than twice the gain from creating new ones.
Exactly. It highlights that protecting the carbon stocks we already have in these traditional agroforests has to be a massive priority. We could lose far more than we stand to gain if we only focus on planting new trees.
That really reframes the strategy. Protection is arguably even more important than creation in this context.
It seems so. And there's another nuance here. The difference between carbon and biodiversity goals.
I assumed more trees meant more biodiversity, which is also good, right?
Generally, yes. But the analysis found something specific. Tree density. How many trees are packed in was the main thing driving differences in carbon stocks. More trees, more carbon. Makes sense.
Okay.
But tree diversity, the number of different species didn't independently seem to increase the carbon stock significantly. However, diversity is what drives the biodiversity benefits.
Ah, I see. So if you optimize purely for carbon density, you might end up encouraging monocultures of fast-growing trees.
Which would store carbon effectively, but you'd lose the biodiversity co-benefits that come from having a rich mix of species. A purely carbon-centric approach could miss the bigger ecological picture.
Right. The most diverse, complex agroforests might be best overall, but maybe harder to manage or certify just for carbon.
That's the tension. Those complex systems, often integrating native forest remnants, store lots of carbon and harbor biodiversity. But they're also often the most at risk if the financial incentives only reward simple biomass accumulation.
Okay, let's try and wrap this up. Key takeaways for you, our listener. Agroforestry. Huge climate potential, definitely a powerful tool. Billions of tons of carbon sequestration possible.
The carbon market side is still really immature and complex, high risk, especially for smallholders. The reality gap is stark, lots of modeled potential, very little documented actual revenue from credits so far.
So for it to work on the ground, especially for small farmers, it seems blended finance is essential. You need the income from the farm products, probably some grants or subsidies, plus the carbon revenue, potentially topping it up or covering initial costs.
Right. And aggregation and technical support are non-negotiable to overcome the MRV and scale barriers.
And there's this potential synergy with new regulations, right? Like the EU deforestation regulation.
Yes, that's a really interesting angle. The EUDR requires geolocation data for farms to prove products are deforestation-free. That same data is foundational for Carbon Project MRV.
So farmers complying with EUDR might get a premium price and be halfway towards being ready to sell carbon credits anyway, kind of stacking the benefits.
Exactly. That could be a powerful way to make it viable, finally aligning trade policy with climate finance on the ground.
Okay, so lots of challenges, but also pathways emerging. We want to leave you with a final thought, though, going back to that creation versus protection idea.
The challenge seems to be not just valuing the carbon we grow, but putting a real immediate financial value on the carbon that's already standing in mature biodiverse systems, especially those at risk.
So ask yourself this. If the main financial signal from the carbon market strongly incentivizes planting a new sapling, perhaps more than it incentivizes saving a 50-year-old diverse agroforest, are we actually driving the best climate outcome? Or are we potentially undervaluing the ecosystems we most need to protect?
That's a fundamental question the market needs to grapple with if agroforestry is truly going to deliver on its incredible potential.
Indeed, a complex picture, but hopefully this deep dive has given you some clarity. Thanks for joining us.